Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode 290 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. This week we are deviating from our normal schedule of events to welcome Matt Monero on to the podcast as our guest. Matt provides great research usually through X is where we see him. And if you've been listening to the show over the years, you should be familiar with us sharing his work. So welcome to the show, Matt.
Thank you guys so much for having me. This is my first real podcast appearance, so I appreciate the opportunity.
Nice. I hope you remember us when you make it really big, that we were your first podcast, and hopefully it's not the last.
But I'll definitely remember you guys.
Hopefully it's not the last time we have you on either. So you can just take a break or a couple sips of coffee for a couple minutes, Matt. As always, we will quickly review the month-to-date and year-to-date performance of the major market indices that we track. This data is from YCharts, and as of the market close on March 5th. S&P 500 index is down 1.9% for the month of March and down 0.7% for the year. The Dow Jones Industrial Average down 1.9% for the month and up 1.1% for the year. The NASDAQ Composite Index down 1.6% for the month and down almost 4% for the year. The Russell 2000 Small Cap Index down almost 3% on the month and down 5.7% on the year. And bucking the trend for the first time in a long time, the Vanguard All World ex-United States ETF up 3% for the month and up 8.7% for the year. 3-month Treasury rate at 4.35%, the 2-year Treasury rate at 3.99%, and the 10-year Treasury rate at 4.28%. So, Matt, I know you brought a bunch of charts with you that you wanted to share with us and have some conversations around for the majority of the show. But before we get into that, can you just share a bit about your background and how you got into market research and analysis and what your current position is today?
Yeah, absolutely. So I guess I'll rewind back to college. I went to Union College. I played football there, part of the investment club, did all the things, right? Economics major. And my senior spring, I had been watching Tom Lee on the Compound and Friends, actually. And I just was like enthralled by it. His research was so good, and I wanted to work for him, right? So I shot a cold email to Fundstrat, and they actually gave me an opportunity there. And so I worked with Tom for a year and a half. It was a great experience. I made all the charts for his daily sort of research note. And then I split from Fundstrat about a year ago, and a few months later got hired by Ritholtz to really elevate their chart game. So that's where I am now.
Yeah, awesome, Matt. Yeah, it's two really titans or pioneers in our industry and what we do, and one on the obviously investment and research side, more heavy on the stock analysis and stock picking, and then over at Ritholtz with what they're doing and building their RIA and mixing in financial planning and utilize technology to set themselves apart and give clients a unique experience. So no, that's great. But if you want to go ahead, Matt, I think if you just want to start talking about some of these charts for everyone listening. This will be up on our YouTube page where Matt is rolling through these charts. You can see them there, and we can also include these in our show notes for those who are just traditional podcast listeners. But Matt, I'll turn it over to you.
Awesome, thank you. Yeah, so I brought the charts. I tend to talk off the charts. Everything I do is in charts. Michael and Josh call me Chart Kid Matt on the podcast. I think in pictures at this point. So So
It's
yeah, so I
nice
guess
to connect a face with a name because I listen to Michael and Ben quite frequently. So yeah, nice to put a face with a name.
absolutely, yeah, I'm the guy. Um, so all right, so the first chart I brought is the gain in previous bull markets going back to 1949. And so what I want to show here is the current bull market that started in October 2022. We're up 63% since the low. So that sounds pretty good, but just for listeners, right? The average bull market is a gain of 192%. So we're only a third of the way there to the average. Now, if you see the dispersion of bull markets, right, and the gains is pretty high, right? You have the bull market between 1966 and 68. That was a 48% bull market. So that was the smallest out of all the sample sizes that we have here. And then you have the 87 to 2000, right? Like the roaring 90s was a 582% sort of bull market there. So there's a wide dispersion in returns here. But the takeaway here is that we are not at the implied gain in a bull market, at least historically. So important for people to keep this in mind, right? For people trying to call the top or anything like that.
Yeah, and we're hearing a lot of that right now, actually, with the first couple months of the year here, Matt. And I think the thing that I took away from this chart was if the bull market were to end today, then it would be the second least amount of gain in a bull market going back to 1950, right? And you mentioned 1966 to 68, but if the bull market ended today, it would be the second worst bull market since 1950, and I think the probabilities of that are low, and I think it's especially during these times with how volatile the market's been over the past couple of weeks, it's important to remind people of that.
Yeah, absolutely, right. I think the historical context always matters, and so to assert that this is going to be the second smallest bull market in terms of gain, I think that's a bold claim to make.
Right.
I'll move on. So now we're looking not at the percentage gain in bull markets, but the length of bull markets. And so we're 876 calendar days into the current bull market, and the average bull market lasts 1,900 calendar days, give or take, 1,927. So again, we're in terms of time, we're really only halfway to the average. And kind of bringing it back to what you said before, Mark, was like this would be the third shortest bull market since 1949. And there's
Right.
11 bull markets in the sample, right? So again, would be a bold claim to make.
Yeah, for sure. And I know, over the past couple of months, Ryan Dietrich, I'm sure you're familiar with him, was sharing his work on this stuff. And that's where I first saw it and got my hands on some of this data. But it is important to remind people of this. And like I said earlier, especially in times like these where the VIX is up in the mid 20s and, there's 1+% moves either way in the market for the past week or so. It kind of, not saying that the bull market has to make it all the way to 1900 days, but probabilities are low that we finish here.
That's right. Yeah, the probabilities are certainly low. And again, there's dispersion here, right? We've had as fast as a 651-day bull market between 2020 and 2022. That was, of course, from the COVID low to the early 2022 high. But yeah, I think just top calling here, it's probably tricky to do. So I'll just move to the next one here. So we're looking at pullbacks in bull market. So this has been a pretty volatile bull market so far. We've seen 5% pullbacks since October 12th, 2022, which was the low. And the average is 8. So this bull market has definitely been characterized with some volatility.
Yeah, that's an interesting one. Go ahead, Matt. I was just going to say it's interesting because I wouldn't have guessed that we've even had at least 6. To be honest, it just shows you how good my memory is. But it hasn't felt that much. But go ahead.
Yeah,
Jessup.
And Mark's slightly ahead of me on this, Matt. I think what happened is we had a period of time last year in 2024 where we were just in this low volatility environment. And one thing that we were talking about consistently in the podcast in Q4 is when that volatility returns, it's going to feel worse than it actually is. And this is a good reminder, this chart, just to tell people, hey, in these uptrends, in these bull markets, 5% pullbacks, 10% corrections are not abnormal. But when you're in the midst of it, just like we are now, that's when you have all the clickbait headlines, all the bold calls for all the market tops. And the thing I'm concerned about is there are listeners and investors out there listening to this podcast that might see one of those headlines, Matt, and completely act and change their financial plan. And this is just one of my kind reminders. Invest for your time horizon. This noise, believe it or not, is not abnormal for the markets. And so corrections and sell-offs are normal. That's my reminder.
Absolutely right. Tune out the noise. Corrections, sell-offs, they're normal. Stay the course. All the words, right?
Yep.
And I think it's a good segue to this chart here, which is time in has historically beat time in the market, right? And what I mean by that is the chart, for the listeners who can't see this, is showing 3 lines. Okay, it's a chart showing the growth of a dollar in the S&P 500 since 1950 in 3 scenarios. The first scenario is if you invested all days, right? You put your dollar in January 1, 1950, and you kept it there all the way through yesterday. And your dollar would have turned into $351. Now, this isn't inflation adjusted. We're talking nominal terms. But if you were to miss the best 50 days since 1950, right? So if you were to miss those top 50 days in the S&P 500, the return of those days, instead of $351 being your final growth of a dollar, it drops to $26. Dramatic, right? And if you were to miss the best 100 days, your dollar only grows to $5, right? It's like 98% less than if you were to keep it invested. Just missing those best 100 days.
Yep.
Right. So it's a clear takeaway. You just need to buy and hold, and it's a simple formula, but it's hard in practice, right? To sit on your hands and do nothing. It's one of the hardest things for people to do.
That's right. They want to take action. Taking action means I'm doing something about the situation.
Right. Absolutely. Right. And it makes them feel better about it, which, you can understand. There's few things in life where not taking action is the right move, right?
And this is definitely one of those.
This is one of those things where no action is the best action.
Yeah, I thought. Go ahead, Mark. I don't want to cut you off.
No, I was just gonna say I think this is one. I think of myself as a pretty tech forward person, Matt, but I think this is one area where technology has actually maybe hurt investors over the long run, being able to, trade your investment accounts and your retirement accounts with a click of a button on your phone and within an app.
Mm-hmm.
I think makes it easier to make significant changes to your portfolio when one maybe shouldn't be making those changes. Whereas, if you just look back 25, 30 years ago, if you wanted to place a trade, you had to call someone, you had to get out of the phone, make time in your day to do that. And it was just the barrier was harder to be able to trade. But now when you can trade in 30 seconds, this doesn't help this situation, I don't think.
Totally. I mean, we have apps on our phones, right? We don't have to call a broker, right? The barrier to making the trade, the time barrier is so much less.
Right.
Which I don't think is good overall, right?
No.
For investors.
No.
Just delete the app, right?
Yeah.
Just delete the app. Don't even check.
Right. Check once a month or twice a year, 4 times a year, whatever. But, checking it every day and stressing about it every day, it's not going to help the situation. It's just going to hurt the situation. Right.
That's exactly right. Okay, here. So we've got the S&P 500's annualized return in 4 different scenarios here. If you were to stay invested fully since 1950, if you missed the best day of every calendar year, if you missed the best 5 days of every calendar year, and if you missed the best 10 days of every calendar year. And just for the listeners that can't see this chart, if you were to invest fully since 1950, right? Didn't take your money out, 8.1% annualized return. These are price returns. It's with dividends, it's even higher. If you miss the best day of every year, your return drops from 8.1% annualized to 4.7% annualized. If you miss the best 5 days of each year, your annualized return is actually negative 4.4%. And if you miss the best 10 days of every year, your annualized return is negative 12.2%. So there's a 20 percentage point annualized return swing between being invested fully and missing the best 10 days of every year. And just so we can kind of conceptualize what losing 12% a year actually looks like, that, a dollar invested in 1950, when you miss the best 10 days of every year, negative 12% annualized turns into like a penny, right? It's essentially you lose everything. So again, just stay invested, right? Don't try to time the market. And another thing to note is these best days of every year tend to happen at turns, right? Coming out of turns when people are the most fearful. And so I think it's important for people to recognize that, because around those turns is when people start getting skittish, right? Those are when people get bearish. That's when positioning gets negative. And so those are actually the times when you have to really be disciplined in your portfolio.
Matt, just to add to that, I think you said that perfectly. What happens a lot of times is people panic, they see these headlines. Matt, I'll get back in when things are a little bit better. But what happens by the time it feels comfortable to buy again? A majority of the rally and the recovery has already happened. They missed out on these days. And that's what concerns me short term right now. And I'm seeing that, right? And we can see a lot of the money flow data. We can see some of the sentiment, surveys are at extremes. I saw one sentiment survey, the AAII, is at number 7 going back in the data set to the mid 80s, which just blows my mind. And I think what's going to happen is whether that recovery starts today on March 6th or it takes another month. When it starts to recover, it is, in my personal opinion, the rally is going to be fierce. And so there's a lot of cash on the sidelines. I think positioning is very light. Sentiment is extreme on the bearish side on a shorter term basis. And when you see this type of data, it just backs up everything that you've been discussing.
Right. I mean, what you really want to see in a bull market, and for the bull market to continue, is you want to see small bouts of volatility create lots of negative sentiment,
Yes.
because that means that they're reflexive to price, like more so than, if I guess what I mean is, if the market dropped 5% and everybody stayed bullish, that's actually a bad sign for the market, because there's
Agreed.
still no fear, right?
Agreed.
You need a wall of worry.
Yes.
And so what's good for the markets right now, we could talk about outlook and stuff, is that we actually have some semblance of a wall of worry.
Oh, yeah. I love climbing that wall of worry. And kind of opposite to what you said, even though the market hasn't sold off tremendously, if you looked at a lot of these sentiment indicators, it feels to people like a 20-25% correction when you compare similar bearishness in history. It's
Yes.
extreme on the opposite side, which makes me more bullish, right?
Exactly right. And I agree, right? We've never seen, we had a 3% pullback, and we had 60% of people in the AAII survey, which is public data, you could look it up,
Bearish.
vote that the stock market would be down over the next 6 months, which is their vote of bearishness, right? That's
mind blowing.
Yeah, it is mind blowing, and it actually makes me more optimistic.
Sure. Yeah, because if people think that, Matt, their portfolio is positioned in that way, meaning they're not fully levered, they're going to have some dry powder, and I think that's very, very an interesting point. Yep.
So something that Tom Lee at Fundstrat told me when I was working for him was that the sell side is the sell side sentiment. I know AII is not sell side, but if you see strategists, or if you see even individual market participants getting bearish, it means that they've already positioned that way. Exactly what you just said.
Correct.
And so it means that they've already voted in their portfolios
That's right.
as negative. And
That's right.
so there's actually, when you have an elevated amount of negative sentiment, you also have really negative positioning, which means that, markets bottom on when fear is the highest, right? We just
Yep.
know that historically. Um, so yeah, and I guess one last chart to belabor this point of don't try to time the market based on anything, right? There's a lot of news about politics right now and who's the president, and I just want to make a point that if you try to time the market based off who's the president, historically it's a losing strategy. So a dollar since 1950 has grown to $351 today, but under only Democrats, it's grown to, that dollar has turned into $44, right? So if you bought when a Democrat was elected, you sold when a Republican was elected, and you did that all the way through today, your dollar only grows to 44. If you invest only under Republicans, your dollar only grows to $7 since 1950. So there's just this massive swing between staying invested and not. And so just don't try to time based on politics. It doesn't work.
Yeah, and we obviously talked about this a lot, Matt, leading up to the election, and it's something that people don't want to hear, right? Based on what party they support or which way
Right.
they vote. They think that all Democrats are bad or all Republicans are bad or everyone's good, vice versa. But what I like about this is like there's no forecasting with this. There is no, oh, because Trump's in office, I think this and this is going to happen. It's like this is the data up until, Biden just left office, right? This is the hard data that we've had, and you can't dispute this, right? I mean, you can
Right.
dispute policies and how they're going to affect the market when certain people are the president, but this is stuff that you can't dispute. So, Matt and I always tell at least our clients that, hey, we all have our own political views, and that's totally fine. Just keep your political views out of your portfolio.
Absolutely. Yeah, that's
Yep.
something that Callie Cox always says too. Separate. And Callie Cox, of course, the chief market strategist at Ritholtz Wealth Management. Separate politics from your portfolio. It's just going to be better for you in the long run.
Right.
Yeah.
All right, guys. So I thought we'd do a quick. Where are we at on time? Just so
We got another 10 minutes.
it's only 10. Okay, cool.
Yeah.
So let's talk just market performance in 2025 right now, because I think there's been really interesting price action. So this is as of yesterday, right? This is the S&P 500 return. This includes dividends, and we see healthcare is the leading sector today, followed by staples and real estate, and then the two worst sectors that I think are real notable here are discretionary and tech. So it's been a real flip from last year, from the start of last year, right? And I think this is really just the leaders passing the baton to the laggards of last year. And I see staples at up 7%. That does make me somewhat cautious, right? Like for staples to rip 7% this year, of course, people buy staples when recession fears increase. So seeing staples up 7%, I really respect price. And that does give me a little bit of concern. But I think overall, looking at this, I think this is just the S&P 493 playing catch up to the Mag 7.
I think it's a good viewpoint, Matt. I think the other aspect, when I see this chart, what comes to mind for me is earnings growth this year. And you start slicing and dicing it by sector. I'm still of the thought process that the tech sector is going to exhibit some pretty good earnings growth this year. So now we start looking at the calendar. Early March, we're going to hear from all these tech companies at the end of April. And we just talked about sentiment and positioning. And it's my thought right now that tech is under-owned. So now you got a game of chicken. The chicken is end of April, we're going to hear earnings results. And if you are one that is bullish, I happen to be bullish on the tech sector right now, personal opinion, you have the market playing this game of chicken. Are people going to start getting into the names that are going to exhibit earnings growth going into the end of this quarter? Or is it going to be kind of more of a rush in April? Who knows? But I'm of the thought process, we start getting all of a sudden closer to earnings season, and all of a sudden I think you're going to want to own some of those tech names because the healthcare and staples aren't going to be exhibiting that type of earnings growth. My 2 cents. What's your thoughts when I say that?
I think that makes sense. I mean, if you look at earnings growth, like you said, for tech specifically, tech is actually is expected to grow earnings. I think it's 20% over the next year. So to see it in a 6% drawdown, I mean, it feels kind of dislocated from fundamental reality. Now, of course, price and fundamentals are two different things in my view.
Yep.
Um, and often I think price leads fundamentals. So I don't know if this is somehow pricing in a deterioration in tech earnings
Which it
that
could,
could potentially be
right?
happening.
The market could be right here.
Yeah, the market could be right, and I certainly respect the market. But I do sympathize with what you're saying. If you believe in the bull market and you believe that we're going to continue making new highs, it's very difficult to say that tech is going to lag, because just historically tech has led in bull markets. It's just something that's happened. Now, could this bull market be different? Absolutely. But just going off the historical data, it would suggest that, tech would do some sort of catch up if
Yeah.
we continue.
And to add to that, I know Mark talks about this a lot on the podcast. Sector rotation in these uptrends over time is the lifeblood of the sustainability of a bull market. And
Right.
so just because, say, tech has been underperforming since December to now doesn't completely negate the fact that we're still in an uptrend. Right, Mark?
Yeah, you got to have, rotation among different sectors, or else you have what happened in the early 2000s with the tech bubble. It was just like tech, 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 tech for so many years without a breather, and then you get the tech bubble burst, right? Two things that stand out to this chart for me, Matt, is just like how dang important like tech and discretionary is to the overall market, right? So you have tech and discretionary down 6.3% and 7.5% respectively, and the market's negative for the year, and you have 9 of the other sectors that are positive for the year, but the overall market is down. So it just goes to show you how important tech and discretionary are to this market. And the second piece that I took away when you were talking about staples, Matt, and how it's up, 7% on the year, and it could give some people some cause for concern. I agree with that. However, I wouldn't start really getting concerned until um, Staples is outperforming on a relative basis, but on an absolute basis is falling with the rest of the market, just maybe not as much as the other 10 sectors or the market in general. But
Great point.
but like we were just talking about, to me, this is just simple sector rotation, and for some really beaten up, unloved areas of the market to have their time in the sun could last a couple weeks, could last 3 months, could last the rest of the year. But healthcare and staples and real estate have been pretty bad on a relative basis for the past year or so. So doesn't surprise me that we're seeing a rotation into some of these areas.
Totally. I mean, the rubber band was really stretched for a lot of those areas, and I think we're seeing a little bit of that unwind, at least in the beginning of 2025. So I think it's a little bit of that.
Yeah.
This is just a look at the major index performance this year, right? We've seen this sell off. A lot of people, talking about recession recently. I saw a chart earlier from Josh Brown, who was showing the odds on Polymarket of a recession in the next 12 months, I believe, something like that, was 38%. So some recession fears coming back into the market. I think that's getting priced into these major indexes.
Yeah, and I think a lot of that too, and I think you have a chart in it somewhere in here, Matt. But I think the forecasted negative GDP growth in the first quarter for this year has something to do with that as well. And we all know that, or at least the three of us know that, the formal, recession is 2 consecutive negative quarters of GDP growth. So if we have one, the fear is, well, there's a higher probability that we're going to have another one, right? Which I'm sure we'll get to that chart here in a little bit.
Right. Yeah. And so here's just a look at the breadth, right? So we're looking at the percentage of stocks above their 200-day moving averages for large, mid, and small caps. And so we see a little bit of breadth deterioration across large, mid, small. The 20-year average, or I'm sorry, the current percentage of stocks above their 200-day moving averages for large, mid, small are all below their 20-year average. So a little bit of technical deterioration. I don't think it's anything to really say, this is the top or something. But the internals have definitely weakened a bit. And then here, I pulled a few economic charts just to give everybody an update, right? So just looking at the hard data, right? The monthly change in non-farm payrolls. This is not a survey. This is actual people getting jobs. So the change in non-farm payrolls over the past 3 months is 237,000, which is very elevated, right? So at least looking at the hard data, like the job picture looks solid looking backwards. Now, tomorrow we have a jobs report. Tomorrow's Friday. Tomorrow's Friday, March 7th, and we have a jobs report. And consensus has a pretty weak number there. So we'll see what we actually get. And then just sort of skipping ahead to some of these other charts, right? So the unemployment rate is kind of pegged at 4% right now. We have seen it climb recently. This is something that Callie Cox has talked about, and I think that we should all just pay some mind to this, right? We need the unemployment rate to rise if we have a recession, right? At 4%, it's hard to have a recession, right? So we'll kind of monitor this going forward. And then we got the initial unemployment claims this morning, and the number came in below expected. So it came in at 221K. So that's pretty solid. And inflation, of course, has cooled from the highs. We have 3.3% year over year on headline, and 3.3% year over year on core and 3% on headline inflation. So we're seeing some moderation. Of course, a little bit more inflation fears coming back now that all the tariff talk is here. And then lastly, there's this massive decrease in the Atlanta Fed GDP now forecast. That's kind of bucking all of these, like the strength in the payrolls number and the unemployment rate saying low. This is kind of bucking those the trend there with the data looking strong. A lot of this is tariff oriented, but there is a lot of hard data in here. And it's just, again, something that I think we should all pay some mind to. I think we all have to acknowledge that there are some legitimate fears right now regarding the economy. And, this really shows that.
Yeah, agreed. Well, I think that's a good place to leave it off there, Matt. Really appreciate your time this morning. Charts were great. Hopefully, most people end up watching this on YouTube to see exactly what we were talking about here. Yep. But before we go, Matt, if people want to follow your work, where can they find you?
Yeah, absolutely. I am just at Matt Sermonaro on Twitter or X, and just Matt Sermonaro on LinkedIn. You can find me. I post a lot of the charts we use, any one-off analyses I'm doing for the guys here. So yeah.
Well, again, thanks for your time, Matt, and hope everyone enjoyed listening to the episode here today. And we will be back with you next week for episode 191 of the Independent Advisors Podcast.
Awesome.
Take care,
Thank you guys so much for having me.
You're a rock star, Matt. Thank you.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.